right, it's 12:30, so we're going to get started on time as usual. Good afternoon, everyone, and welcome back for another exciting edition of the Foremost Real Estate Investment Series, or FREIS. I'm Ricky Dogan, VP of Investments at Foremost, and I want to thank you all for joining us again today. Before we get started, just a reminder that FREIS is in support of Face the Future Foundation, a truly amazing non-for-profit organization that raises money to fly North America's top head and neck surgeons to the developing world, where they provide life-saving and life-changing surgeries. This charity is so phenomenally efficient and lean that each dollar donated buys $45 in equivalent healthcare services. To date, FREIS has raised in excess of $20,000 for this incredible foundation, which unbelievably translates into almost $1 million of medical services. Face the Future is celebrating 25 years of transforming lives and have an amazing virtual Zoom Gala planned on May 27th. Tickets are $250 and include a 3-course dinner from Oliver and Bonaccini and a nice bottle of wine. They also have a no food option for $100, and we encourage you to check it out. To show our support and to help Face the Future increase their awareness and exposure, Foremost is offering tickets for the no food option to the first 10 people who send me a private message in the chat function. If you would like to find out firsthand what Face the Future does from the comfort of your own home, please let me know, or better yet, buy a ticket for the food option and invite your friends. We also ask that if you enjoy today's session that you do make a donation. I will paste the link for the event and the general donation link in the chat, and please remember that no amount is too small. Our sponsors really stepped up to the plate to help us smash last year's fundraising, so I want to take a minute to thank them. The platinum sponsor for this year's FREIS series is MBC Managed IT Solutions. MBC is an award-winning, security-first managed IT services provider. Since 2000, MBC has been helping Canadian businesses grow by handling their corporate technology needs through cloud solutions and managed IT services. MBC's clients are very unique, operating in different verticals. However, what they share among them is the desire for IT to be simple, secure, and modern. For its constant efforts to improve its clients' IT, MBC has earned multiple awards, including Excellence Canada for Customer Delight, Engaged Employees, Innovation, and Sustainable Financial Results. They have also been named one of the top 50 Canadian managed services providers by Cloud Tango for the 2nd year in a row. We would again like to thank all our amazing sponsors who have donated directly to Face the Future. A warm and hearty thank you to MBC, as well as Equitable Bank, Ernst & Young, HSBC, and Evans Investment Council. I honestly could not be more excited for today's guest, and looking at the number of attendees who are filtering in, I think that is mutual. And I think his experience and stories could probably fill several hours, so I'm going to pass it off to Evan really quickly. Leonard Abramsky is a true community builder in every sense of the term. He is not just a thoughtful and exceptional real estate investor, but a real leader in his community. He is the vice chair of the Jewish Foundation of Greater Toronto and recently the co-chair of the 2020 UJA annual campaign, amongst many other charitable endeavors. Leonard has had an exceptional career, starting out at CBRE before becoming a managing director at TD Securities. In 2005, he joined Brookfield Financial as a managing partner with a mandate that included overseeing the firm's extremely successful international expansion. Today, he is the president and founder of the private real estate investment firm, the Dunloe Group, as well as a board trustee for First Capital REIT, and he is here to share some of his incredible insights and wisdom with us. So, without further delay, please welcome Leonard, along with our CEO, Evan Cooperman. Please note that you may need to click on the screen to change your view so that you can see their video feeds.
Okay, thanks, Ricky. You can hear me? Yeah. All right, so we're going to get right into this, Leonard. We're really excited to see you. Thanks for taking the time. You know, when we asked Leonard to do this, he very quickly agreed. And I think that's just because he knew it was for charity, and Leonard is exceptionally giving of his time. And so we sincerely appreciate you joining us today. We're going to get right into things to make the most of our time. So, Leonard, The Globe and Mail described you as a top Canadian rainmaker at Brookfield, who is a heavy hitter who brings in the Canadian real estate business. I'd like to go back in history and find out, I want to be a heavy hitter. So I want to find out, what does it take to become a heavy hitter? Can you tell us about your career and how you became interested in real estate?
First of all, I want to thank you and Ricky for inviting me to participate today and the wonderful work you're doing on behalf of charities and truly making a difference in the community. So I want to, first of all, acknowledge that. Heavy hitter is a term that the Globe and Mail used. Ironically enough, when I left Brookfield, my brother bought me a license plate that said ex-Rainmaker, which I still have, but I will refuse to put it on my car. So go back in history. I did not grow up in Toronto. I grew up in Kingston, Ontario, and that'll come back later in my history. But I went to school in Boston. I did a degree at Boston University in real estate and investment finance in their School of Management. And I came out and started interviewing in Toronto because I wanted to be back in Toronto, and this was 1984. And I was interviewing with different firms, and there was a gentleman that suggested I try the real estate brokerage business, of which I had no idea that it even existed in my hometown. It was basically you sold houses and that's it. And I didn't know there was a commercial real estate career. And CB, which was called Coldwell Banker at the time, was just starting out. And I was employee number 6 of Coldwell Banker Commercial in 1984. And I stayed there and did office leasing, did retail leasing, got into investment sales, ended up selling a lot of shopping centers and kind of got focused on that. And in 1995, they put my picture in the paper as their #1 investment sales guy in Canada. And the day after, I walked out the door and started my own company with 4 other wonderful individuals, a little group called Cornerstone Commercial, we called it. And we were focusing on high-end investment brokerage activities. And so we did that for only 3 years. I don't say unfortunately because it worked out well, but we had a plan to kind of build this group and then eventually sell to a larger group. But TD Securities came along. RBC already had a platform like ours, as did CIBC and as did Scotia, but TD did not. And they kind of gave us the proverbial offer we couldn't refuse. And we became known as TD Cornerstone back in '98. And we had to stay there 3 years in order to get paid the equity that they owed us. And but I ended up staying there 7 years. And then ultimately Brookfield came along and kind of gave the proverbial offer they couldn't refuse. They had an office in Calgary, Toronto, and Montreal. It was called Brascan Financial at the time. It was the predecessor to Brookfield. And they had gone through some HR changes and needed some new leadership. And so I decided to go there, and I was in my early 40s. My father always taught me that you have nothing for sale except your name. So if you keep a good name, you can do great things. But if you don't keep a good name, it doesn't matter how much money you have or how successful you are, you're not really worth anything. So I always focused on that in my career. And I always focused on the idea that I was there to do the next deal, not the deal that I was working on. And by doing the next deal and focusing on the next deal, you were always focusing on the fact that you had to maintain the relationship with the client and put the client first ahead of your own interests. So anyways, I've had a wonderful run, and I've had a wonderful run. I was at Brookfield, and then Bruce Black came to us who's the CEO of Brookfield, came to us in the late '09 and said, we're global. I don't know if you guys know, we're global, but you guys have 3 offices in Canada, and why aren't you global? Which was another way of saying, get on a plane and start to build a global organization. So myself and one of my partners, for the next, I guess, 5-6 years, we ended up opening. We opened 15 offices in 9 countries, including India and Germany and Australia and Hong Kong and Brazil. And I was really fortunate. I got a global MBA during that time, but it was a great run. I've been involved in a lot of fascinating transactions on a global basis, and especially in Canada. I was thinking the other day, I've actually sold almost a property at every street corner along Yonge Street between basically Shepherd down to Front Street over my career. So it's been fun. I can't hear you, Evan. You're on mute.
happened? That's weird. Okay, you can hear me now?
Yep.
All right, thanks. Just on the international experience, well, two things actually come to mind. One is just if you don't mind commenting a little bit more on the international experience and how it was different. And also, I guess you took on a different role from your past. Did you enjoy more of a growth expansion management role as opposed to doing the deals?
Yeah, it was a very different role. You quickly learn when you're doing international expansion, which I had never done before in my life. You always know cultures are different, but until you actually experience those cultures and it wasn't a case where we went in and bought different companies in different places. We built from the ground up. We went and hired the heavy hitter in each place and grew an organization from there. Culturally, very, very difficult to do. It felt like, I used to joke with the management group, like between all these offices and all these countries, every day was a holiday. There was never a day in the calendar that wasn't some holiday somewhere that I couldn't have all the team together. So you quickly learn, all these nuances that you have to focus on. And I also saw that from my perspective, I loved managing deals, which involved people, but I really didn't love the management of people. It's really not a skill set I've learned to perfect over time. It's all I can do to manage, my own life. But I do love the people aspect, but I love the action of the transaction. I don't love the action of the management side. But I absolutely see it as a critical part to growing any organization.
Right. So I guess now you get to focus on the deals now that you're retired, and we'll get into that. But before we do, I think it is important, and you've got some great views on this. So I do want to spend a second just on your community stuff. Mm-hmm. You do a lot, and it's tremendously time consuming. And if you don't learn how to say no, you can be full time almost in the community. I am curious to know, because you were obviously working quite hard in your professional life, why you chose to carve out the time to do it.
Completely selfishly. I'll be brutally honest with you. I viewed it as when I got into doing community work. First of all, I grew up in a family that was very community minded. My father and my mother spent a lot of volunteer time and charity dollars making a difference in community. And they taught my brother and my sister and I that was actually an important part of our lives. So it was not a question in any of our lives that we would be involved in community. But from a selfish perspective, I learned early on, especially in the real estate game, there were a few members of my tribe that were in the real estate game and also involved in Jewish communal work, as an example. And I learned very, very early on that if I was seen to be involved in community, I was treated better in my business life too. So it was a very symbiotic relationship, and it worked both ways. Initially that's how I got involved. I was very involved in my kids' schooling, in terms of being on the board of directors and operating on that, and then got involved in the larger community in different universities and different, obviously very involved in the Jewish community, UJA. But I absolutely saw that as a critical part of my life, and I wanted also to constantly set an example for my children who have seen this and emulate it today.
Okay. All right. Thanks. So we might come back to that if there's time. I don't know if there will be, but I really do want to get into your views. We had a prep call yesterday, which I wish we could have recorded, because I just hope we can replicate today what we spoke about yesterday. But I do want to get into your thoughts on the economy and real estate in general. And so I think we have to start with the fundamentals. So fundamentally, if you read Dave Rosenberg, you probably believe more in the deflationary arguments. And if you read the press everywhere else, it seems like you probably believe more of the inflationary argument. So do you have a view, which I guess will also then shade your view on interest rates?
My view is over time, we will see inflation come back. We just won't see it, I don't believe, for the next 24 months at least. I got off the phone an hour ago with my former partner in Munich. We were on a Zoom call together. He was telling me about a new business he's involved in. But he was which is an advisory business. And he was telling me they just financed a logistics warehouse for Amazon in Germany at minus 0.5 interest rates for 10 years. So doing the math, the bank is paying you to take their money for 10 years. I think that's very deflationary. And when you can buy a 2.5 cap, it's actually a pretty good deal on a relative basis. So my point is, I think we are lower for longer, but I don't think we're forever. When I was growing up and taking my first house mortgage, it was 11.5% in 1988. And just so you all don't think I'm a real estate genius, I lost money. I lost half my equity on my first house that I bought in Toronto between 88 and 92. It's turned out okay since then, but you know, everybody does make these real estate mistakes eventually. But if you don't get involved, you don't do it. But you know, that was 11.5%. My parents used to tell me they borrowed money for 6%. And I'd think, wow, 6%, that's crazy. And then you talk to somebody else in the early 80s who borrowed money for 18%. Today, our kids are taking mortgage money for 2 to 3%. I think that we're going to be here for a while. I don't think we're going in any material way. Could we see 4? Yeah. I don't think we're going to see 6 and change for a long time coming.
Okay. All right. So that'll form, I think, the basis for some of the follow-up discussion. So you really believe in lower for longer, which right now is maybe contrarian. It wasn't necessarily contrarian even 3 to 6 months ago, but that's just the story in the press today. So I think that it'll feed 2 questions. So I'm guessing that most people on the call want to know 2 big things. One, is there a bubble in real estate? And then 2, you know, well, I guess we'll see how you answer that one, but have we missed the boat? So why don't we first start with that one? Do you think that there's a bubble? And you can differentiate between different asset classes if you'd like.
So I'll start by not answering the question. As you know, I spent a lot of time at Brookfield, so I spent a lot of time listening and learning from a guy named Bruce Flag, who's the CEO. And you know, he used to talk that alternatives were going to represent, in a pension fund world, we're going to represent 20%. You know, you have stocks and bonds and alternatives, 20%. Now, if you listen carefully, he's talking about alternatives being 50 to 60%, or in a pension fund environment. And the alternatives, as he says, are no longer alternatives. So when you look at that and the amount of capital, you know, it used to be that pension funds in Canada would put in 8 to 10% into real estate. Now they're all clamoring for 25%, and they're going more, and they're growing from there. And that's why they're the envy of the world in terms of their operational expertise. So all is to say, and comes back to your bubble question, when there's this much capital going to be chasing real estate and continuing to chase real estate, I don't think you've seen the bottom of cap rates, and therefore I don't think we're in a material bubble. Yeah, there will be blips, and you'll God willing, we'll not have the COVID-19s in the world again. But as I used to say, when everybody says it's different this time, that's when you sell, because it's never different. There's just something else taking place. So I would say no. I don't think we're in a material bubble whatsoever. I just think you're seeing natural growth given the amount of capital chasing this.
Okay, so interesting. All right. So then the question that follows from that is, I mean, prices are up a lot. But if I want to deploy capital in this environment, you know, have I missed the boat? Probably not, by the sounds of things. But you know.
I would say if you have a 2-year time horizon, yeah, you probably missed the boat. If you have a 10-year time horizon, you have not missed the boat. And it's a function of what your time horizon is. It's not a function of where we are in the cycle. Like, you know, the old Jackie Mason story, like, I could have bought that building for, yeah, if you spend long enough in the game, you'll be fine.
Right. Okay. So, which I got to ask you the question, are you more of a buy and hold type of guy, or if somebody makes you that offer you can't refuse, you're flipping it?
Well, my brother and I started investing in real estate in Kingston in the mid 90s. He was there and I was doing my thing, and we formed a partnership which has lasted to this day beautifully, and we built up a bit of a portfolio over time in Kingston. But we had to, in order to get going, we had to incorporate a company. So our first company we incorporated was called Fourth Generation Holdings. Because our great-grandfather came to Kingston in the 1880s, and our family, my brother and I and family, still own some of that real estate today, like from the early 1900s. So to answer your question, we're probably more buy and hold. I think the government allows you to refinance if you want to pull capital out in order to do other things with your money, in order to reinvest. And, if you do the math, you're paying a lot in taxes. And if you're happy with the real estate, and most importantly, you have the operational expertise to run the real estate. That's absolutely critical.
Right. Okay. Which that reconciles with our view. I mean, in the mortgage side, the one thing we've noticed is that if you have sufficient liquidity, you can certainly ride out any storms. So if you're not using too much leverage, I guess in real estate ownership, you should be able to ride out the storms. And over the longer term, why we love the asset class is over the longer term, it pretty much will be a positive return.
Yeah, I mean, I always took the attitude, when I was full-time in my other job, that, other people were paying my debts every day and growing my equity by paying rent in a building that I was a partner in.
Right. So you just have to have that long-term view. All right. So far we're on the same page, and I think you'd be on the same page with quite a few people on this call as well. I want to now jump back to Brookfield for a second. So you had this international experience, which gives you a unique perspective for us. How is Canadian real estate perceived by the rest of the world? And I guess if you were starting from scratch and doing it all over again, would you focus on Canada or would you focus somewhere else?
There's a quality of life to Canada that is unbelievable relative to the rest of the world. And I think as a Canadian, and as most Canadians, if you don't travel, you don't appreciate it. So I wouldn't change my Canadian life and my Canadian tax base for anything in the world. The quality of life that we have here is so vastly superior to most places that I've traveled in the world that I wouldn't change that. Having said that, when you're sitting in a boardroom in Mumbai or Sao Paulo or Rio or Sydney, Australia, and you talk about Toronto, the pride of our nation from a real estate perspective, you may as well be talking about Louisville, Kentucky on a relative basis. Like it is on the radar screen, especially on the European radar screen. But it's not really on a relative basis. And actually, if you look at Brookfield, at the end of the day, they've invested in Toronto, but they really haven't done anything material in Canada in a long, long time. It's just, guys and ladies, we are 37 million people in this world. We're not a large population base. We love our own little world, but it is a little world on a relative basis.
So do you think that leads to structural things that are just permanent, or we get more attention over time and it'll change? Because, you'd said to me, where else could you live 10 minutes away from the downtown core and buy a house, for $2 million? So does that change at all, or is that just structurally the way it is for a generation?
My gut is that immigration will help us. First of all, we need immigration badly in this country. It's been obviously shut down over the last 18 months. We absolutely need it to grow this country because we're not reproducing ourselves. So that's absolutely critical. But having said that, I don't see us ever being the power nation in the world in any way, shape, or form. We have two important resources. One's worth a lot these days, called lumber, and the other is oil, which I think is diminishing in its usefulness over a longer period of time, but not in the shorter period, but in the longer period. So we need to be cognizant of that. That's really also why we need immigration. We need technology to grow our base here. Otherwise, I do have longer term concerns about, the health of our economy if we can't get into the new world order, which I think we're doing relatively well, although this hiccup of COVID has had an effect for everybody.
Right. Okay. So let's talk about COVID for a second. I'd like to know what your opinion is on work from home and whether this is a permanent thing. Working from the office is dead. We've had mixed experience here. I'm at the office. I got 3 kids at home. It's loud. Some of our employees are very happily at home and probably don't want to come back. But what do you think? Say 5 years out or even 10 years out, is there a new normal, or do we kind of slowly revert back to the way things were?
Well, I'd ask you to look at my hair. It's gray. I'm old fashioned. I believe in the offices. I believe in the community of working together in an office. And I believe the absolute synergy that needs to take place in an office environment. You may see I'm in an office. I've actually just moved here because I'm doing some renovations in the house, and a buddy of mine gave me his office at Young Eglinton Center. So I'm actually in an office today in a very COVID-proof environment, I might add. But I'm an absolute believer, and I talk to all of my kids are in their 20s and early 30s. And all things being equal, they can't wait to get back to the office and be with their friends, the social experience. I think it's a really tough concept, this work from home thing, because you don't know, there's no delineation, there's no getting home from work, and there's no reason why you don't go back to your desk at 8 o'clock at night, which is not healthy either. So you really need to be able to shut it down, and that whole idea of a commute or delineating between office and home, I think is absolutely critical. And I think, yeah, there's going to be softness in the office world, I think in Toronto for a period of time, but I don't think it's structural. I think it's just a small cyclical issue that cleans itself up, in real estate terms, not long-term, like 23, 24. It's not, this is not a 2030 issue that you're seeing, structurally like in a.
Right. Okay. So
We
I agree with
haven't
you.
overbuilt. By the way, we haven't overbuilt, and Toronto before COVID hit was like a ridiculously successful market. Too tight, actually. Rents were going up exponentially, which was great if you're a landlord, tough if you're a tenant. But we're not overbuilt here, and the demand is taking place. And for all those firms that say, "Oh, we're going to a work from home strategy," my gut is, and I tell my adult children, I don't think you're going to have the same promotion if you're sitting at home and everybody else at your office is at the office and you're zooming into a call. I think there'll be FOMO pretty quick.
For sure. I think there's a lot that happens in the intangibles. Certainly, we're still human beings and the relationships matter, and you get that being in person. I also find it's exhausting, by the way. If you spend the whole day on Zoom, I think your brain has a hard time figuring out that this person, Leonard, is actually not in the same room as me. And if you do that all day, by 5 o'clock, you're fried. And so one quick anecdote for you. We've been struggling to find good deals. And so we're sitting on cash. And so I would say we place a premium right now on putting money out. And there was a deal that I don't think we would have gotten done if my partner and I were not in the office, because we stood across in our offices across the hall from each other and kind of,
Right.
talking to each other across the hallway and bouncing the deal around. And together, there was just this passing conversation that happened, which turned the deal. So I think it's all of that. It's the creativity. It's all of those intangible things that you get in the office. So I would agree with you on that one. So that speaks to office. Let's talk about, so you're on the board of FREIS Capital REIT. They've focused on densely populated urban areas. And I'm wondering if you're willing and able to comment just on how their experience has been through COVID, and what that tells us, I guess, as well about the resilience of portfolios. And by the way, this thesis of the death of the city, right? Everybody wants to move out of the city and everybody's going to work from home. What's been the insight you give us from FREIS Capital?
I would say the death of, well, I won't speak on behalf of FREIS Capital, but I'd say the death of the city was a 20-minute phenomenon that probably took place last September to October 10th, and it's over. And if you look at condo prices, they've all started to come back in the heart of the city. So there was a window, but that's over. I would say FREIS Capital, when it comes to their portfolio, is a tremendously resilient portfolio, because it was focused on two things. It's focused on urban, and it's focused on everyday essentials. So most of our stores were able to remain open, and we were able to help those tenants that couldn't remain open or still can't remain open. But most of our, I think they just released our results. I know they did, and I can tell you our results were strong in terms of occupancy and in terms of rent collected, and they're back to pre-pandemic levels, basically. The thesis of the company now and what they're doing is growing in populations over 300,000 people in a 5-kilometer radius. So that is a big focus called the super urban strategy. So obviously we're focusing on the Greater Toronto area, Montreal, Vancouver, VECTOM I call it, Vancouver, Edmonton, Calgary, Toronto, Ottawa, and Montreal. And they have sold much of their real estate in the secondary markets. but their secondary markets were not as small markets as some of the other REITs. And now they're growing their platforms. If you look at a shopping center, a typical shopping center, take Lawrence Square, which is not a property they own, but just it's probably some everybody can relate to. Well, that property sits on 10.5 acres and has 25% coverage. So it's 250,000 feet on 10.5 acres. Well, if you look at it from a zoning perspective, you say eventually, that could be redeveloped. And in today's world of density, you can take a site that's 25% coverage and make it 5 times coverage. You don't need to do the math, what that land is worth. So I focus on First Capital as an example, and RealCan and many others. These are land banking opportunities that you're getting paid to hold. And if you take it on that perspective and not ignore, you have to focus on the noise, but not put as much emphasis on the quote unquote noise on a quarterly basis of rent collections and bankruptcies and things like that. Just because a tenant goes bankrupt, it doesn't mean that the real estate disappeared from the face of the earth. The real estate's there, and more importantly, the land is still there. And as you can see, there is a premium for land in the greater markets in Canada.
Okay, so it's an interesting thing because I listen to you talking and I think, okay, this is your opportunity to go off and buy some good pieces of land that you can land bank. At, there's vacant stores, there's bankrupt tenants. Now's your chance to do some distressed buying, but there hasn't really been much opportunity to do that. And so, why is that?
There's a thing called the Government of Canada, and they made a determination during COVID that no man or woman should go without. And therefore, they have subsidized this pandemic to the extent that they have, and you can read the numbers and figure out the math. So as a result, you've not seen the distress, and you've also seen lenders play the game well and say, look, this is not caused by any, and landlords as well. This is nobody's fault. And when it wasn't done through, this didn't happen and cause people to have grief because they were negligent or ignorant or had malfeasance. The reality is this was a global pandemic. So everybody really did step up. The lenders stepped up, the landlords stepped up, the tenants stepped up as much as they could, and the government stepped up. So as a result of all these people stepping in and putting their hands in together, you have not seen the distress, and I don't think you will see the distress, other than maybe some hotels as an example, for those that can't hold on. But other than that, no, in a real estate perspective.
Right, and something that you'd said yesterday that struck me was you talked about the changing nature of capital as well. I guess back when you started, it was a different owner. I don't know if you want to comment on that.
When I started in the business, there was a company called Cambridge Leaseholds, which was a public company. There was Bramalea, there was Olympia in York, there was Cadillac Fairview. These were either private or public companies run by private or public entrepreneurs. Cadillac Fairview is now on the Ontario Teachers Pension Plan. Cambridge Leaseholds merged with Ivanhoe, which became a subsidiary of the Caisse de dépôt de placement. BC Quadrille is a real estate company that was formed out of BCIMC, British Columbia Investment Management Corporation. Oxford used to be a public vehicle. It was a private company, then became a public vehicle, and now it's OMERS, Ontario Municipal Employees Retirement System. And I can go on. So the capitalization of all of these companies, and hence why you will not see like the quote unquote bargains and distress of downtown office buildings. All of these companies, including Brookfield, own these assets. So as a result, there's no debt basically south of Queen Street, if you want to really look at it. These are all well-capitalized assets by large institutions, many of which, if you have a pension, you're probably a participant in. If you're a teacher, you own a piece of Yorkdale. These were long-term strategic investments that were made. So as a result, you're not going to see the distress in this country that you otherwise would think that you would.
Right. Yeah, that was our sense as well. I mean, we thought we were going to go try going after. We have a small equity business. we were going to try and go after distressed condos, but that play lasted about 1.5 months in
Right.
November and December maybe of last year. But there's really, I guess we're just in our last quarterly report we wrote, you don't fight the Fed. There's just too much liquidity out there.
Right.
All right, so I just want to switch gears for a sec. In Toronto specifically, we like to think about everything in terms of supply and demand, and think about long-term drivers. And from a planning perspective, what should the city be thinking about? I mean, right now you have the most valuable land is condo land, and everything seems to be becoming, condos. What's your perspective on how the city should be approaching planning for the next generation?
So the issue, I think, from a city perspective is you don't want a city full of condos, because those condos, the values are so, they grow so quickly, and the land value goes so high that the average person can't afford to live in the city as a function of that. So it really requires a mixed prospect. The other comment I would make is, as it relates to office buildings or functionally obsolete office buildings or whatever, most people are looking at that and saying, no, it's, that's a great condo site. But you absolutely need employment lands, and you need people to be able to work and play and live within the city in order for it to be a viable city. One of the beauties of Toronto is our downtown has tremendous residential and has tremendous commercial. So it makes it a very vibrant place to live. What they've tried to do with mixed success, or limited success, I would say, is build these condos that are more like homes, more like New York City, where you could bring up your family south of Queen Street, as an example, in one of these. But the problem is the price per square foot. If you look at it, at the end of the day, you're still buying condos for $700,000, $800,000, but now they're shrinking and shrinking and shrinking to the point where they're not unlivable, but they're getting pretty tight. So as a result of that, I think it's absolutely necessary. Immigration is absolutely critical, but I think from a city planning perspective, to get back to that, you need a mix of employment land, not environmental land, employment land, as well as maintaining a certain office space for employment purposes.
Right. It's an interesting thing that I never really considered, is that you are losing all of your employment density over time. So something to file away for people to think about. With apartment buildings, a lot of people I think are long-term owners. There's talk now about a change in the tax and the capital gains rates, and as a long-term owner of real estate, I'm wondering if that would change your calculus about whether you would consider selling if somebody made that Godfather offer. And the only reason why I asked the question is because, again, thinking about supply and demand, do you think there'll be opportunities for people to acquire buildings that otherwise would never have been for sale, because people want to get stuff sold before taxes go up?
First of all, I was never good at calculus to start off. And my kids are listening, so no, we're never selling. No, I would say it wouldn't kind of affect my thinking at this stage in my life, but it is affecting others' thinkings. There are, I'm aware of a few large portfolios, as well as many families for, I would say, family planning, estate planning purposes, are considering the sale. A lot of these apartments, as you correctly identified, were built by immigrants that came here after the war in the late 40s, early 50s, and grew an apartment base and grew thousands and thousands and thousands of units. Well, it's now going to a next generation, probably sooner than later. And these families are starting to look at the costs of that, because at the end of the day, as you know, our government will deem it to be a disposition whether you sold it or not when it passes to a next generation. So there's a lot of estate planning taking place in that regard, and I think it's driving some of the thought process. The other thought process that it's driving is, as these families, as you go from quote unquote G1 to G2 to G3 generationally, G3 and their children and their spouses and whatever have different thought processes than G1 did. So as a result of that, A lot of these families are now focusing on the fact that, you know what, maybe it's easier to, well, first of all, give more away charitably, which is always a good thing. And also it's easier to leave the next generation more liquid instruments than a real estate business per se. Having said that, that's not the thought process with everybody. Everybody has a different thought process.
Right. Okay. And your guys who are listening to this call better understand that it's you're gonna have to change the holding company's name to G6.
God willing.
All right. So a creative thinking question for you. So COVID has kind of illustrated that there are these exogenous things that happen that can turn things upside down. Going back, if you think about supply or demand, but let's focus more on supply. Are there any, could there be things, I mean, you touched on immigration, but what would be the big game-changing exogenous things that could happen that would change the calculus? I know you're not good at calculus, but the Greenbelt would have been one, way back when, right? So massive changes or unanticipated changes in zoning or taxes, what should we be thinking about from a risk management perspective when
I think from a risk management perspective, taxes are always critical, and how our government views that both on personal and corporate basis. I think the REIT structure that came into this world in the early 90s. Little fun fact: RioCan, the name Rio, stood for retail, industrial, and office, because they weren't sure. They didn't have any plans to necessarily be a retail company, and then it kind of evolved into, and that's where the name RioCan came from. But that was the early 90s, and I've been involved in a lot of these REITs from that point in terms of being a service provider to them. But they've evolved, all the REITs have evolved, and they've evolved because they've had to. They never used to focus on development, they used to focus on acquisition. And now they've run out of acquisition opportunities, so they have to focus on development in order to get their yields higher. But those yields come with higher risks because it just takes longer to get things done. But in terms of exogenous shocks, yeah, the government can change the REIT legislation. That would have a material effect on things, and they have in the past, and they will in the future. And many of you on this call about 10 years ago, they watched as they did that. There's usually outside events that we can't predict. Global pandemic, I'm not going to hang my hat on because it happens once every 100 years, God willing. But what we saw in 2009 with the financial shock that took place in the GFC, we weren't overly affected during that time. We saw the tech bubble. There's always something that has an effect, but I think real estate is tied more to the stock market than it ever has been before, just as a function of its capitalization. And you can see the institutions, being the pension funds, they're not participating in this, overly active bidding environment. What they've done is they've taken their money and said, okay, we're going overseas. And so they're in England and they're in Germany and they're in India growing portfolios because their capital can be moved around. And they have the luxury of setting up operations in global basis. But from an exogenous shock perspective, I have one saying that I always say is, when they tell you it's different this time, it's never different this time. It's only a matter of time.
Right. I'm actually reading a book. There was a book written after the financial crisis called "This Time Is Different" by Rogoff and Reinhardt. It was an analysis of basically debt bubbles. And I went back to read it because it seems like we may be living through one right now. And that's what they say, anytime somebody says this time is different, that's when you should be running. All right, so a couple of other things I want to cover on. You've got good visibility across asset classes. So if you were thinking about that G3 type purchase or the G4 generation type purchases today, so the long-term holds, which asset class, if any, would you focus in on? Would it be apartment, industrial, residential, commercial, all of it?
I'd say again, it's a function of your ability to actually run the real estate. So assuming you have great management in all assets, I like retail. Although I do believe you need a certain level of franchise power in retail, i.e. you have to be able to negotiate with a tenant in multiple locations, not just one. If you're one, you can be vulnerable. Although in soft times like this, being a single landlord is probably easier than a multiple landlord, because the multiple landlord, they make demands of on multiple locations. And the single landlord, they have a little more understanding as to your capitalization versus that larger REIT. So I like retail, but as I like it for what I told you before, and that is the land banking opportunity. You know, that site that you buy with, I syndicated a deal a few years ago to some investors that I'm a partner in. And I liked it because it was 5 and change acres on 38,000 feet of land. And there were high rises next door. So we've not done anything except run the real estate at this point. But I keep eyeing the fact that, 5 years from now, maybe we could rezone this site and create multi-story. So that I like the ability to turn that and make it something else. I think apartments are long-term safe bets, especially in student markets where there's students. And the reason I like student markets, not to say student housing per se, but markets where students rent from, is that they're always turning. So our government allows you to get market rents once the tenant leaves, but not while the tenant is there. But if you own student-based housing, then it's always turning within a 2 to 3 year period or 4 year period. So I kind of like that ability to mark to market, so to speak. The office building business, way too much capital, I think, for the average investor. But it takes me to my other point, and that is, I don't think one should be afraid to invest in a basket full of REITs. If you have $1 million today to invest, or $100,000 to invest, I think if you choose best in class management teams and really focus on the analyst reports of what the net asset value is and what the discounted net asset value is, most of these groups are trading at 20% discounts to NAV, and you're getting a great yield. And it's amazing. If I took somebody a shopping center and said, you can buy this strip plaza for six cap and the market's 5 cap, they'd buy it, they'd give me an offer tomorrow. But if I told them they could buy the same stock that had the same attributes, they would question it. There's a natural, for a lot of people, there's a natural disillusionment with the capital markets. But I think if you don't buy a stock for a 1 week period and you view it that you're going to hold it for a 5 year period, playing in the REIT space is not such a bad place. And there's tremendous transparency amongst all of the REITs in terms of and quality of management amongst all the REITs.
Right. Just going back a second for the multifamily, because one of the things that we worried about, or at least thought about, was potential changes to rent control. They did it in New York. It's not, if you're in multifamily assets, do you lose sleep over that, or just you'd ride it out?
I think you ride it out because at the end of the day, governments change too. Nothing lasts forever. You'll have some governments that say 1%, 0.5%, and then they realize the buildings are falling apart, so then they need to make changes, or they end up with new governments that say, no, landlords have a right to make money too. So the difference is when you have a tenant in a multifamily building, you have a partner in that multifamily building versus a tenant in a commercial space. It's not viewed with the same possession of ownership as a person's home, so to speak. So
right.
I do have sympathy to that fact.
Okay, I need to work in a shameless plug. So how do you feel about investing in private mortgages?
Unbelievable. How do I feel? I'm actually a big believer in it, and I'm a big believer in investing in, and I have invested in funds as opposed to individual mortgages, because I believe that your team at Foremost and others who are in the space are underwriting. They give an investor diversity of portfolio and diversity of risk. Because if people send me mortgages all the time, do I want to invest? And I'm not interested in a piece of one deal. I don't mind that from a real estate perspective, from an ownership and an equity perspective, but taking on the credit risk associated with the borrower. If I'm running the real estate, that's one thing. But if I'm taking the credit risk of a borrower, I'd rather you do the underwriting and make sure that it's done right. So I'm actually a big fan of it. And I think to me, it's in my world of portfolios, it's replaced, not that I have such a massive portfolio, but it's replaced, it gives me bond-like characteristics, but better yields. But not, I'm not a long-term 0.5% Canadian bond kind of guy.
Right, and we do feel, obviously, I mean, we're drinking the Kool-Aid, but we think that there's still good compensation for taking the risk in what we do. I mean, if you look at high yield bonds right now, so junk bonds are yielding, depending where, 3 to 4%.
Right. I would rather own your mortgage fund for a 6 and change all day long. And to me, it's a much safer, more prudent investment than that. And you have much more visibility in these things.
Here. Well, we should end there, but we won't.
But it all comes down, I would say, it all comes down to the management. And you know, we're always reading in the paper of these situations with unfortunate people that have less scruples than yourselves that are involved in the mortgage business. So to me, it's like anything. You need to underwrite the manager and then figure out the deal after that. So you need to get comfortable with the people you're investing with, because at the end of the day, people make decisions, not machines.
We agree. That's actually why it was very strategic that we have the foundations of Foremost in the background, because I really believe that it's important that what I learned in my past life, which was consulting to wealthy families about investing in companies like Foremost, it's all about the people, right? If people want to screw you, they're going to find a way. And to your point about your career, you always focused on doing the next deal, and which meant focusing on the relationship. You got to find managers who think like that.
Exactly.
So I agree. All right. So just to take it home for the youngsters on the call who value the wisdom acquired with your gray hair, I do want to just go back and ask you a question about, in your career, what's the toughest situation that you've had to face in your career, and what can we learn, from that?
Toughest situation. I don't know the toughest situation. I would say that, I used to tell my kids I fail at 95% of the things I work on a daily basis, which I did. So, my career as a whole, you have to have a certain, not that I have any special mentality, but you have to have a certain mentality to be able to get up every day and face failure. And there was a saying I learned when I was interviewing, failure is a resting place for success. So I would say that, for me, I failed at a lot of pitches. You go in and you pitch and you think you won it, and then you get a call 2 days later that your competitor got it. So there was a lot of failure in that. There wasn't as much failure once you got control of the product. But in my business of investment banking and brokerage, the failure was not getting control of the product. And there was a lot of failure. But every time, some of my competitors would call and scream at clients and how come we didn't get it? I never did that. I always called them and thanked them for the opportunity and asked, what could I have done better? And a lot of times they had lame excuses as to what I could have done better, which wasn't really. But I think it was, again, going back to what I said before, I was trying to learn and also setting the table for the next transaction. And I think that's probably a great lesson for anybody listening, is always try to learn from your failures, and don't view them as failures, just view them as stepping stones for success. But also don't be afraid to go out and try something new. I mean, I was very comfortable at CB. I could have stayed there the rest of my career, and many of the people I work with are still there. And I walked out of there to start my own with a few others. Then we went to TD, and then I went to Brookfield. So I kind of sold myself a few times and tried to advance myself in some way, shape, or form. And really kind of make a difference and stimulate my mind in terms of a career relative to what I was doing. So never view it as failure, just view it as the resting place for success.
So I think at SpaceX, they've kind of said if they're not failing, they're not innovating. And so they encourage a culture of failure, which is great. And so we'll close it off on this whole idea of culture. I mean, you've worked within a few very successful organizations. I know you didn't enjoy necessarily managing people, but if people are choosing either a company to go work for based on the culture, or from my point of view, a culture that they would want to instill within the organization. What do you think the hallmarks are of a good culture in an organization?
I think at the end of the day, it's having management that listens to you, not being afraid to voice your opinion to management, because I think the best organizations really listen to everybody within the organization, and that's absolutely critical. And I think taking a collaborative approach and realizing that if you're the senior person, you don't know everything, and if you're the junior person, you know a lot more than you think that you do. And coming up with new ideas and coming up with creative ways to, whether in my case it was marketing real estate at the time, and engaging, and I had to do it on a global basis for a while as well, which is not as easy. But making everybody feel like they are part of the team and really understanding that they are part of the team. And you can't do anything on your own. When I left CB, I was like, oh, I was the #1 guy. Oh, that company is going to fail tomorrow. No, they actually are doing quite fine. Thank you very much. I left TD, the same thing. I always left with the ability to walk back in the door the next day and get my job back. And I would say that is absolutely critical. The other comment I would say to those that are listening is don't be too quick to jump jobs. I see in a younger generation, the ability, the desire to, oh, I was here 1 year, 2 years, and you look at a LinkedIn site and went, I stayed in my first job 11 years, my second job basically 10 years, and my third job 11 years or 12 years. It doesn't hurt to stay in organizations. That's how you build relationships in organizations. And that's why I've been fortunate that I can make a phone call to most people in the real estate world in Canada, because I've stuck around a long time building those relationships as opposed to jumping ship constantly. Don't develop that reputation.
Right. No, I appreciate it. I'm just checking the Q&A. Somebody popped in a question. Oh, they said, Evan and Ricky, don't listen to Leonard. Don't you dare leave foremost. So I guess that was before. And then he said, see, don't jump jobs. Okay. So we're not planning on going anywhere. So listen, we like to start on time and end on time, and we're almost there. So Leonard, I really do want to thank you. I mean, for a retired guy, you're pretty busy. You're in an office. You're wearing a sports jacket, which I know is for us. So thank you. But you are busy.
Stuff, actually.
I put on a belt today. It was the weirdest
Exactly.
feeling. But we do really appreciate the fact that you took the time. It's really kind. So thank you very much.
And more importantly, I want to thank you and Ricky, but also thank you for what you're doing in the community, because it's not always about making money. It's making our community a better place for which you can make money and also make a difference. So, congrats to you, and continue your good work from a community perspective.
Well, thank you. Appreciate that. I also want to thank Ricky, because Ricky does most of the work and I get to take most of the glory. So Ricky, thanks for getting this all together and making it work so smoothly. I want to thank our sponsors. So NBC, which is our IT company, Equitable, Ernst & Young, HSBC, our bankers, Equitable and HSBC, and Evans Investment Counsel. Give Daniel Glazerman a call. He's one of the people who, to Leonard's point, is somebody you can trust, which is important. We really do appreciate all the sponsor support of FREIS. We've been able to raise a reasonable amount of money, and we haven't asked people to pay for these calls because we've got the sponsors. So thank you. Finally, I want to thank everybody, the guests on this call, for being on the call. Thank you very much for taking the time. Our next one coming up, mark your calendars, is September 23rd. It's our Q3 session with Mark Wiseman. Mark, to the point about pension funds, I mean, he's played at the upper echelons of institutional investing for a long time. He was the CEO of CPP, which means all of us were beneficiaries of his work there. He was also the global head of active equities at BlackRock. And he's currently the chair of AIMCO, which is the Alberta Investment Management Corporation, which manages over $120 billion. So I'm confident he will have some fascinating insights. So that's actually, believe it or not, after the summer. So everybody be well, enjoy the summer, and stay out of trouble. And we'll see you guys in the fall. Thank you.
Thank you.
Take care. Thanks again, Leonard.
Okay, bye-bye.